Now, it's a pretty good day overall in the market. We have the Dow up 1.24%. We have the S&P 500 up 1.08%. We have the small cap index up 1.32%, and we have the NASDAQ up 0.63%. Now, something you should notice, I did those in order for a reason, because the NASDAQ is underperforming everything, and that usually means that even though the market's going up, we're going to very high quality stocks like the Dow Jones. Okay, so anyway, not the point of the video. The point of the video is to talk about JP Morgan and why I think this stock is a dead cat in bull's clothing. Okay, so statistically, a dead cat bounce is when there is an event decline of 20% or more, and then it has to be an event decline, and then after that, there's a short bounce from the bottom, and then 80% of the time, and that is an actual fact, 80% of the time, the stock continues lower. Okay, so with JP Morgan, we had the event right here at about $40. The bottom of that decline was at $32.50, so that gives us about, over 20%. And then it went a little bit lower on divergence. We had some buyers step in, and now we're coming back up. So I am honestly waiting for a further decline. Okay, so what can we do about this? I think that, well, first we have that 80% probability going with us. So what I'm going to do is I'm going to use a demarc retracement, which it's the same exact thing as a Fibonacci retracement, except you measure where you put that actual retracement, defined as the highest point between the lowest low and the last time that the market hit that area. So I would say, okay, what is the lowest point between here? What's the highest point between there and there? And it's right there. So that's where I'll draw my retracement. So here's what I'm going to do. I will go from the top closing day all the way down, and it gives us a price target of just about 36.67. So we expect JP Morgan to go up, but we expect it to hit a lot of resistance right there. So for those of you that would like to take advantage of this trade, this would be a very tight stop trade. We get in the trade, and if it goes much above this level, so it would be like a short sell at 36.50, and then stop loss at like 37.15 on a closing basis. So we have like a 65-cent risk, and where do we expect it to go? If you want to, this is another thing that I do very often, you would take the entire Fibonacci bracket and you would project it down from the top. So projected down from about 36.50 or 36.67, that retracement, it gives us a price target pretty darn low, down at the $20 mark. So this is a traditional dead cat bounce trade. We keep our stop very tight, we keep trailing it, and it's a very high reward, low risk trade. If we get stopped out, so what? We lose 65 cents. If it actually does what we want it to and goes down to 21.71, remember, I do think we're in a bear market, that means that our reward is like it's like 15 bucks. So 15 bucks per share. You do 100 shares of that, you just made $1,500. Not bad, right? Okay, so that's how you trade it. Now, other things I want to quickly look at. I think that it's going to keep going up, and this is why. First off, in the daily RSI, we are in, first I did a study that said that when the market goes into buy mode like this, it normally means, well, when it breaks a trend line, it means that's going to go up. But it also said that normally it's going to hit resistance around the 50 level. So I still think it's going to go up, but it's going to hit a brick wall around this 53 level on the RSI. On a shorter term chart, that, by the way, that means there's still room to move. On a shorter term chart, notice that it is staying above this 40 level in recent days. That's very bullish, and it's being overbought but not oversold. That's very bullish. So this is one of those things. Don't short sell yet, but when it gets to that level, that 36.67, or I'm just going to do 36.50, get ready to pull the trigger. All right, thanks for watching.